Canaccord Genuity Chief Market Strategist Tony Dwyer is with us today. Tony, great to see you. You've done a really nice job of not getting too emotional on either parts of the swing in the past year, I'd argue. What do you make of this last push?
So which market? I think Sarah just did a great job of giving the recap of the Fed policy and the inflation expectations bumping up. But Carl, you know, the Russell 2000, which is up about 2% today, was down 7%. From the peak as the S&P is making a new high. So that broadening, we came into the year thinking it was opposite from where the stage was set for a rally going into the end of October. You were historically overbought. Fed expectations had gotten down to the level that I thought they would be, and that was totally outrageous at the end of the year, so in the third quarter. So at this point, there's such confusion about what the Fed policy is going to be. And as Sarah suggested, it's going to be data driven. We got a lot of data right ahead of us. But
your job is to make a call. I mean, it sounds like you're reticent to make a bold call in either direction.
Well, I'll tell you, over the next 6 to 12 months, we did a study that showed when the percentage of S&P components above the 50-day moving average over the course of 10 days gets to 90%. So you've got the vast majority of stocks in an intermediate term uptrend above the 50-day for more than just a day, for 10 days, every time you've been higher 9 and 12 months later. So that's really the call. The question becomes, where do you get more aggressive in owning those stocks? And that's where we're a little bit dicey near term, where we've had this run up in the S&P 500. We've had this consolidation or intermediate term consolidation and everything else. So we're kind of in this no man's land. And what we need to see is maybe a little bit more fear come into the market to really attack for that 9 to 12 month gain, Carl.
You know, Tony, when it comes to that broadening that we all thought, or many thought, not we all, but many thought we would see, and obviously we've gotten the opposite with the continued strength of the Mag 6, as we now call them. We're leaving Tesla off of it, as per Jim Cramer. I mean, what do what are your expectations on that front? Can that kind of momentum continue at this point, given how surprising perhaps it's been?
I really think it can. I think that's got to be the story. So you're already at 33%-ish of the top 10 stocks as percent of the S&P 500 is higher than it was during the Nifty 50. It's higher than it was during the peak of .com. And both of those ushered in a 15-year decline in the top 10% stocks as a percent of the S&P. In other words, the troops started to catch up with the generals. And David, it wasn't because the generals tanked. It's because you got this re-ramp in the broad market. And I think the sign of that is in that indicator that we came up with when those, the percentage of stocks above the 50-day moving average in the S&P gets not just to 90%, but does it for 10 days. That's a bullish indicator. So all the market momentum stuff is telling you want to add to exposure. We just want to do it when there's a little more clarity on some of the macro data.
Well, we're going to get a fair amount of that this week, Tony. Maybe we'll check back in a week and a half. Tony Dwyer, thanks as always.